Good morning, everyone, and welcome to this week's lecture. So, today we're going to explore one of the most important topics in modern finance and risk management, which is essentially how artificial intelligence and machine learning are changing the way organizations identify, measure, and manage risk. So, we'll build the foundation for understanding this critical intersection between risk management and AI technology. So let's go over the learning objectives for today. So first, we'll define what we mean by a risk model. Then we'll explore the business value that AI brings in risk management. Then we'll discuss how AI is actually being used in risk management and what challenges organizations face. Next, we'll examine AI's importance in mitigating losses. And finally, we'll introduce the fundamentals of AI and machine learning, the technologies that are driving all these changes. So these are not just theoretical concepts. These are tools and frameworks that major financial institutions, insurance companies, and corporations are using right now to protect their assets and futures. So let's start with the basics. What exactly is a risk model? So a risk model is fundamentally an application of quantitative methods, analytics, and algorithms to quantify, which means to measure and express numerically, both financial and non-financial risks. Think of it as a mathematical translation machine. It takes raw data about uncertainty and converts it into numbers we can understand and act upon. Now, while risk models can apply to many industries, like healthcare, manufacturing, and government, in this course we're focusing primarily on the financial services industry. That's where risk modeling has become most sophisticated and most critical. Banks, investment firms, insurance companies, and hedge funds live and breathe risk models. They use them to decide whether to approve a loan, how much capital to hold on reserve, whether to enter a new market, or how to price an insurance policy. When we use the term model in this course, we're specifically talking about what we call a financial risk model, which is a model designed to quantify financial risks like credit risk, market risk, or operational risk. So let me give you a more formal definition. We can define a model as a quantitative method, system, or approach that applies statistical, economic, financial, or mathematical theories, techniques, and assumptions to process input data into quantitative estimates. So in other words, you take theoretical frameworks, things like probability theory, econometrics, or financial mathematics, and combine them with real data and some reasonable assumptions, and what you get is a numerical estimate of risk. So here's an example. Imagine a bank wants to know the probability that a loan applicant will default within the next 5 years. A risk model might use statistical techniques to analyze thousands of past loan records, looking at factors like credit history, income, debt-to-income ratio, employment stability, and so on. It learns patterns from this historical data, then applies the same patterns to new applicants' information to generate a probability of default. That probability is the model's output, which is essentially a number or quantitative estimate of risk. Now, the use of risk models is now absolutely universal in financial services. It's not optional anymore. It's foundational to how the industry works. Every major financial institution will have entire teams dedicated to building, validating, and maintaining their own risk models. Now, here's where things get interesting. The emergence of AI and machine learning is forcing the financial services industry to rethink how they approach the entire risk model lifecycle, from conception through validation to deployment and monitoring. So traditionally, building a single statistical risk model has been a time-intensive process. We're talking months of work. A typical team of quantitative analysts, data scientists, and risk managers might spend 3 to 6 months developing a single production quality risk model. They need to understand the problem deeply, explore the data extensively, try different mathematical approaches, and then validate the results rigorously. And finally, document everything completely. So now you might think, well, that's the price of doing things right. And to some extent, that's true. You do need rigor and care when you're building something that could affect millions of dollars in business decision. But what has been discovered through experience is that while a lengthy development process does help ensure accuracy, performance, and proper validation, organizations have also realized that a significant portion of the time isn't actually being spent on these valuable activities. Instead, much of the effort is wasted on inefficiencies caused by fragmented legacy systems across the risk model lifecycle. So if you think about it, data lives in one system, model development happens in another system, validation will use a third system, deployment will go through a fourth, and then each handoff is manual. Each transition loses information or introduces error. Each system will use different tools, different data format, different definitions. So all of this creates a lot of waste. So a team might spend 2 months just preparing data, moving it between systems, resolving inconsistencies, and dealing with technical bottlenecks. Another month might go to rebuilding calculations in different software environments. And these are all inefficiencies that AI and modern integrated platforms can easily eliminate. So what's the business case for AI in risk management? What value does it actually create? So AI and machine learning have enormous potential in several key areas. First, accuracy. Machine learning algorithms can often achieve better predictive accuracy than traditional statistical models, especially when dealing with complex nonlinear relationships in data. So traditional models make strong assumptions about how variables relate to each other. Machine learning can discover deeper patterns that traditional approaches might miss. Second, data handling. So this is huge because modern organizations are drowning in data, and not just structured data in neat rows and columns. There's a lot of natural language data and other unstructured data. So they have unstructured data like text from emails and documents, images. For example, if you're working on properties, risk management related to real estate, you have photos of the properties, audio from call recordings, social media feeds, sensor data, and much more. So traditional statistical models don't work well with unstructured data. Machine learning has no problem dealing with unstructured data. It can extract signals from text, images, and other complex data that traditional models simply can't process. Third, agility. So markets change, customer behavior shift, new risks emerge, organizations need to respond quickly. So AI-powered systems can adapt faster to changing market conditions and evolving risk landscapes. They can retrain and update continuously rather than requiring months of manual development. So more generally, AI and machine learning have proven themselves effective in solving complex problems across industries. And we're seeing accelerated adoption due to the explosion in big data technologies and digitalization. Every organization is becoming more digital, collecting more data, and needing smarter ways to make sense of it. So let's make this more concrete. So businesses can leverage AI in risk management to fundamentally transform and streamline their risk assessment processes. Instead of slow manual analysis of structured data, AI systems can analyze massive volumes of both structured and unstructured data simultaneously, delivering faster, more comprehensive risk assessments. Companies around the globe are already doing this. They're leveraging AI to ensure legal compliance and risk mitigation. Why? Because the regulatory environment is becoming more and more complex and data heavy. Data regulations are multiplying. And then you have an extra critical problem, which is traditional methods of data oversight and compliance monitoring are becoming unreliable exactly because of the sheer volume of the data. You can't have a team of humans manually reviewing thousands of transactions per second. We need AI to do it. So we'll continue our discussion in the next part of the lecture.